Thank you very much, everyone. Welcome to another session of RM Smart Investing. I hope all had a wonderful week so far. Today's subject is it's about gold minings, and again, with the year that we have started, I've spoken about valuation. So I thought, why don't we dive in and analyze the industries and this situation with the interest in inflation, interest rates, and gold and minings, from copper to silver to platinum, palladium, zinc, aluminum. So everything, basically, it will be a good opportunity, perhaps, get a little more familiar of analyzing mining stocks. One of the things, again, I hope, this is only probably for an hour or so. We're just going to touch the surface, but hopefully by end of the, our session, you will have a better understanding of how the mining stocks work and how they are different than other industries. And this is important. I think you have to take into consideration that the sectors, the industries, they're not analyzed the same way. It's not about reading one book and how to do fundamentals, because each industry, and again, each sector and each industry has its own story and it has its own valuation system. So something like mining stock is completely different than airline stock, or basically completely different than, let's say, banking stocks. So with that in mind, let's first of all define what are mining stocks. So when we talk about mining stocks, we're basically talking about companies that they are in the business of producing and exploring minerals, and they are a type of the commodities. So some of these minerals could be uranium, coal. It's really still, in a sense, iron, cores, copper, silver, gold, platinum, palladium, aluminum. So basically, they are based on commodities, and they are, because of that, they are affected by the commodity prices. And on top of that, so you have the risk of the bigger picture, the commodity prices. On top of that, they have their own business and operating risks. So that's right there is the differentiation between gold or any type of a commodity, mining commodity, let's say, actually investments, and the mining sector, because not only you have to follow the commodities, but you have to have individual analysis of which could be the equity side of things, and also individual from quantitative side to qualitative side to management. So really have to do really the good due diligence on analyzing those. One of the things also when we talk about commodities, when we talk about mining, is anything which is under the ground. When we think about under the ground, the commodities, we could think of crude oil, we could talk about natural gas, and of course the gold and copper. Then you have the above ground commodities, which usually it's the agriculture. So they are really either being planted and grow above the ground, could be grains and or could be animal stock, livestock. So milk, which is a byproduct of that, eggs. So those are the above the ground. Mining is under the ground. And so basically the mining stocks, it does perform very well. Obviously, it follows its commodity and the prices move up. But also they very much obviously dependent on the global economy. And that's what I thought this is a good timely subject, which what's going on. Again, we've had the 2 years of COVID situation, health situation, ups and downs in the economies around the globe. So basically, I thought it was a timely one. And of course, because of the global economy, then the dependence on the raw material, which that affects, again, these raw materials are important for complete different products, and from cars to cell phones to build energy, to solar panels, solar system, to communications. We talk about construction, to any other infrastructure. So you can see how important they are. And these are important companies in order to bring those up, explore those. So what I want to do is right off bat, so I thought, again, I'm just going to touch probably surface, but these are the subjects I think you should be familiar when you're thinking of the mining stocks. Number one, of course, you want to be familiar with the underlying commodities. So if you're studying gold mining stocks, well, obviously they are very much related to the gold commodity. And that's important. If you're doing platinum, that's basically very much related to platinum commodity. The second thing is commodities have cycles and super cycles. So for instance, one of the things about super cycle, let's say in gold as a whole, we usually could go 20, 25 years. For instance, we started in 2001, 2002. We had a big drop into 2008 because of the financial crisis. Then we had a big move to 2011, then the drop to 2015. Then we had another cycle up, which was gold was like, let's say in gold was about 1,096 or so, somewhere around that. We had another leg up. And usually super cycles, they can last, as I mentioned, about 25 years. On the other hand, the cycles themselves, they could be short cycle, 2 or 3 years, or they could be 10-year cycles. So we want to also watch that when we think about mining stocks and their commodities. The other thing about mining stocks are you have to differentiate when it comes to what type of minings we are talking about. Some are well established, they're producing companies, they actually have discovered whatever mineral that there is, and they are producing. The other part is the early stage junior miners. They are really, these are intact, these are something, it's like really touch and go, they have to invest a lot. So what happens, I think that we will have completely different class, and I'll be happy to do that if there's interest, on actually junior miners analysis. Again, they're in a different situation. There's a lot to do with, the geology of the things. Again, has to do a lot with financing, the management. So there's a lot to do with that. So that will be a separate issue, but you want to differentiate that. So when we talk about miners today, we are mostly working on well-established companies. On the other hand, we just talk about producing companies, companies that actually are have discovered and they're selling their discoveries. But you also have the royalty and streaming companies, which I will explain and give you some ideas into that. The mining stocks, they also have their own very unique challenges, and we will discuss that. All of these commodities, of course, they are very much dollar dependent in a sense that, usually the stronger dollar affects them in most of the time, not all the time, depending on the risks that are around, in an inverse way. So we want to look at that. And a lot of these, again, commodities are very much the story of today is inflation, interest rates. So they're very much dependent. Now, again, we've had a class, let's say, on gold and dollar relationships. So I would like you to refer you to that. So that explains the relationship of inflation, interest rates, and let's say a gold commodity or silver or precious metals. So also the correlation. So we want to look at the correlation of even the miners and their underlying commodity. It's not always one-to-one. So we have to be also aware of that, again, because the miners, they have their own unique features. And there's ways we will look at the correlations. One of the things could be attractive or the hindrance on the mining stocks is the volatility. They are very volatile performing investments. And what happens is sometimes they fall way behind their commodities as far as valuations. They become very inexpensive, especially becomes a big divergence actually from the valuation point of view, such as we had like in 2016. So what happens is all of a sudden gold miners, they became the cheapest in like 72 years. So obviously hand over fist, we want to buy those gold miners. And within 3 months, they were actually up 100%. I'm not talking about as a whole. I mean, the gold miners and the silver miners, they moved in 2 or 3 months over 100%. So this is how they can really move. When they move and when they go down, obviously they go down. So they are risky. They are for speculative investors. If you're going to have a part of your portfolio, you don't want to over concentrate on them. 10 to 20% would be the most, including the commodities in that arena. So that's one of the things you want to take into consideration. Obviously, we just talked about the commodities, the health of the economy, especially global economy. It's all about supply and demand. So that also is important to take into consideration when you're analyzing your mining stocks. The other thing is we found interesting relationship between the railroads and transportation as a whole, but mainly railroads, because there's in two ways, and I explain it now, and the health of the economy plays a big role. So if the railroads are very active, that means the economy is vibrant. And that means there's a demand for these raw materials. So that's one way on the positive side. So we look at, let's say, stocks like UNP or CSX. So what happens is if they're doing very well, they're very active, that's good news actually for mining stocks. The negative side would be the shipping cost. So we have to take that into consideration of affecting the margins. So what could happen? You could have high revenues, so the top line would be high because of the shipping and there's activity, but your bottom line could actually suffer because of the low margins. So that's why it's important to watch the railroads. The last two things are the geopolitics. As you can see, because of the nature of commodities, what happens based on the supply and demand. So if there's any geopolitics, which we are witnessing it now, and we can see how, for instance, it affects commodities like food commodities like wheat and energy sector commodities because of what's happening in Europe, that also it's important to consider about, again, the valuation of these mining stocks, the location that they are in. And on top of that, they have their own domestic political issues, depending on the governments. Again, there were talks with, in South America, for instance, we've had some left-leaning governments from Bolivia to Peru, even Chile, Argentina. So Argentina, but mainly like Chile, Peru, Bolivia. What happens is they can come and just say, you know what, we're going to increase the taxes, or we're going to take over the mining company. So, or we're going to, nationalize them. So basically those are the concerns. So you have to take those into consideration. So, but that's why once you do this, they become either very rewarding or they can be a lagger in your portfolio. So let me start with I just mentioned about the royalty and streaming companies, and we talked about production. Well, if you want to invest in initially, let's say it's the first time you want to do something with the gold miners or any type of miners, we're talking mainly here about gold miners. One of the safest way is the companies that they are not involved in the exploration, but rather they do the royalty and streaming. What they do basically when we talk about royalty, they basically had invested in other companies. So the other companies take the branch of the exploration expenses and all the other things going with it. And these companies invest in them and then they get royalties. And when we talk about, for instance, the royalty, they take a percentage of the revenues. And what they have to do, they royalty and streaming companies, they take their money right on top. So That's why they become more of basically less risky of all the mining companies. So what happens typically, these royalty companies, they invest upfront and then they receive the percentage again off the top. Now the streamer, which is similar in some ways, but they continuously after doing the initial investment, they still investing in these companies after the upfront. And in this situation, as I mentioned, the biggest benefit is not that when the things change, the cost of the supply and demand, it doesn't affect them as much as when the company has to go through, which you will see in the challenges. Now, for instance, if the mining cost goes up, you talk about the taxes. Now, it's their job to deal with it, and royalty still gets there, as I mentioned, because they get it off the top. So that's also it's important. Now, as I mentioned, that's a more of a conservative way of investing in mining companies. The three top ones I would actually my two top ones. The Citico, the OR. It's a little smaller for my taste, but Franco, Nevada, and my favorite, I've been doing the Wheaton Precious Metals, which used to be the Wheaton Mining, and then they changed their name to Wheaton Precious Metals. They are the top ones, and so they will be the ones that I would work with. So that's as far as the royalty. The challenges these mining companies have, obviously, the huge dependence on the price of the underlying commodity. So they could have the best management, they could have the best financing, they could have the best, again, as far as the balance sheet goes, but the revenues is very much dependent on the commodities. There are not companies, you cannot just go market and say, oh, come, because we are better than, this other company. If the commodity price is really down, there is the profit margins will be down. So, or the demands will be down. The second thing you have to think about the challenge, mining is a depleting assets. What we mean by that, I mean, whether you do crude oil, for instance, or you do, in this situation, let's say gold, well, when you explore and discover, now once there's kind of a finite as far as supply there. So as I'm selling this, I'm depleting my inventory. So what I have to do, I have to go either find another mine, another discovery. I have to spend a lot more money to find another thing. And that comes to our third challenge, which is the expensive infrastructure. So basically, again, they have to do processing the plants and gotta go facilitate other mines. And on top of that, in some of the, especially overseas, sometimes it's hard to find. Internationally, it's difficult to reach those mines. So now you have to actually build roads. You have to even find power lines, power plants. So these are extra expenses that, again, when you compare it to, let's say, a banking industry, they're completely different. The other one is the politics. As I mentioned, that the role of the governments, what they could do. You can be in Russia, it could be in Uzbekistan, or it could be, as I mentioned, Peru or Bolivia or South Africa. So Mongolia, these governments, they can change their minds and they can do whatever they want. They can change the taxations rules. So that's important. On top of that, again, there's a lot of union power. There's a lot of times that the labor, they really don't, although some of them, especially like in Chile, they have, they do have labor unions, but a lot of other countries, they don't really have a strong union. So what happens, the working conditions are very bad, and the pays are very low. I mean, most of these miners are not very educated, and they don't get paid very well. So what happens, they have some of the riskiest jobs, and there are times that, what happens is that they go on strike. So obviously it affects the supply. Now, one of the unique things, I mentioned strikes, but I mean, last 2 years, obviously because of COVID, how can you be in the a proximity of someone so close to you and do the mining. So that has been, again, affecting the supply side of things. The last but not least, again, I emphasize the taxes. The taxes could be very much affecting the profitability, and they can be very vary from one uh, region to another. So we have to take that into consideration, and they can go up again depending on the government. So I'm going to jump into this. I just tell you how I look at the mining stocks, given that we've done our commodity analysis, we've looked at the inflation, interest rates, we've looked at the relationship with the dollar. So we look at the macro cap, we've looked at the geopolitical side of things. And I'm ready to actually, I say, you know what, I'll just use an example like gold. Okay, I'm ready to invest in gold. And what happens is, I am but the good thing again about gold is, okay, I can go buy it through the broker. I can have different ways of buying that gold. Could be ETF, could be, buy the bars, and I can hold on to it. So I don't have the problems. Now, on the mining side of the things, mining stocks, some of them are very liquid. So they actually they can give you an alpha. They can overperform the commodities. You can, again, differentiate the company. So there's a pros and cons of actually owning the gold or buying the mining stocks. As I mentioned, because of the volatility and especially the timing, sometimes these miners really have underperformed the gold. When they move, they really move. And I will share that actually in the next chart, how they actually act. So this my 7 criteria. Here they are. Number 1, they have to be well financed. Now, these companies, remember, they have to constantly be on the look for the productions, the new facilities. So we want them to have access to the capital. So when there's no access in capital, well, how are they going to have the revenues if, again, we talk about depleting assets? The second part is strong balance sheets. And of course, we like to have low debt, especially in this environment, what is going on. So we want to have access to capital, but also have a low debt. Third one is the experienced management, which is very important. And we will talk, if you're interested in the junior minings, we want to have a proven records. Management is able to need a finance, is ready to find the capital. They know, they have a good sense of development. They also have a good relationship with whatever regions they are working on, what governments they're working on. On the other hand, I have to tell you that sometimes they do make mistakes. The biggest one in 1980s, we had Indonesian gold miners, which was really, it didn't even exist, but there were so many funds got involved with it. The governments got involved with it, and there was really no mining. There's actually no gold there. So they do make mistakes, but it's always better to be with the proven managements than unknown. The fourth one is, I've seen this, I've been to many presentations, and you want to walk away from the companies that constantly, rather than doing the explorations, looking for financing, growing their company, all they do is just moving from one place to another, marketing their company. So promoting their company, promoting themselves. So they spend so much money on the marketing side rather than developing the company. So that's another one, which brings us to the fifth one. That's one of the reasons I do not like to invest in over-the-counter stocks. Although I've been very fortunate in early 1990s, I actually got involved with a small company. It all depends when you get in. It was a Canadian company, and it was right in the beginning. And I think I took the ride. It was a penny stock. So, and in a matter of 2 or 3 months, we made like 1,500%. But that's anomaly. And I was probably too naive to realize it. So I've learned my lesson. So those are far and few between. So I would stay away from over-the-counter stocks. The sixth one is avoid very high-priced stocks because of the brokers' hype. The prices have appreciated. There is not really much fundamental things going on. It could be the manias. It could be a meme stock, for instance. Last year, for instance, we had as a whole, like in January, we had silver. It was a meme stock. I mean, it was a commodity. So you know how the story ended. I mean, it shut up, and I welcomed it to sell my position at that time. So you want to focus on the fundamentals rather than hypes. And the seventh is I look at the market cap, and we will emphasize that a lot in our presentation. We want to look at the market cap and then see how do they compare to their actual tangible asset estimated the value of their assets, and also the future stream of revenues, the earning power. So we want to make sure they're in line. So that's my seventh criteria. So let's start from scratch. So we got our fundamental, basically understanding of what we want to look at. So let's start, and I like to start with Finviz. It's one of my favorites, free, again, platform, so you can go to that. So basically, when we talk about mining, the first thing comes to our mind is, well, industry would be gold mining or silver mining, but we go beyond that. So it is part of the basic material sector, and it is an industry. And when we look at the basic materials and we look at the different industries on the basic material, we have the agriculture input, but then we have also aluminum, building materials, chemicals. We have coal, we have copper, gold, lumber, other industrial metals and mining, other precious metals and mining, and then we have paper and paper products, silver, specialty chemicals, and steel. Today, I'm going to more focus on basically gold, silver, somewhat copper, and basically other industrial metals and mining, just because of the global economy. So now that we know from the top down, we see these are the industries, then we go one by one. So for instance, we click on gold, and we find out there are actually 44 gold stocks are listed under the gold mining. So what I did, I just sorted by the market cap. So as you can see, the Newmont Mining, which is an American company, they are the largest market cap. And basically then the Barrick Gold is the second, and Franco-Nevada we just talked about, and the Wheaton Precious Metals. So in order of that, so I just want to give you a heads up so we can see what are their principality, where their origin located. And so this is what you could do. So again, these are, you can do it on your own. The other thing is I like to do, part of my valuation of these mining companies, I really like to have positive free cash flows, because that's how they stay in business. Because you don't want to have a hot mining company and then a year later is out of business because there's no revenues coming, or the free cash flow, they have so much expenses, there's nothing coming in, now they have to go finance. So I pay attention. So I sorted the list of these companies based on the price to free cash flow. So those are just for your information. And then we can go one by one. Again, we can choose. We can look at the silver. You see almost every silver which is listed in the US. They are Canadian company. The one that I play a lot, which is the Pan American Silver Corp. Of course, recently we played the AG, which is the First Majestic Silver Corp. But you have these as listed. And then we can look at copper, for instance. Again, basically we're talking about global economy, which is a very important. So these are the listed from the Freeport McMoRan is the largest market cap to Southern Copper, which is used to be Southern Peru. And then TRQ, which is, even though it says Canadian, it's more in Mongolia, and then HBM. So This is how we do it. And then other industrial, they could be from iron ore to other ones. And of course, when we have other precious metals, we're talking about platinum and palladium companies. This is more of an industrial, and they look at, I mentioned, from the steel and iron ore to zinc and completely, all kinds of raw materials. So, and these are the companies. You can see quite a few of them are actually overseas, like in Canada. There's few in America. The largest one being the BHP Group, which is based in Australia, and the Rio Tinto, which has a big presence in all over the world, from Australia to Brazil, but they're based in the United Kingdom. And again, we use the market cap. So the last one, I just want to bring this up. So it would be good to watch the railroads. So I want to just show you there's 12 stocks listed, and these are the railroads. Okay. Now, I want to share this. This is my workspace. This is my radar screen. So I have a chart next to it. But I just want to emphasize how I have set up my my gold and precious metal section, what I look at. And I have sorted it by, again, the largest based on market cap. And this is from Monday, which is 2 days ago, February 7th, 2022. So I've sorted, these are the mining stocks and the gold miners. And then I have the silver miners. And then I have my gold ETFs. And then I have my silver and other precious metals I should have written here, such as platinum, palladium, which has been on fire. And then you have the double, for instance, and for gold miners, you have the triple. So these are all the ETFs. And then I have my inverse ETF. So if I see, let's say GLD or SLV, they're overheated, they're at resistance, rather than maybe buying put options, maybe I can play the inverse. So that's, again, when you look at the super cycle, they come very handy. But they are, again, very much short term. I don't like to use especially leverage ones for too long. What I want to share with you is the GLD, which is, again, it's like one of the largest holders of physical gold in the world. I think it's the 6th largest for some, U.S. central bank in China and maybe Germany. They were up. You can see here that they were basically up about 0.86%. Look at what happened to the gold miners. I mean, we start with GDX, which is the gold mining ETF. It was up 3.85%. Yet you could see there were some stocks up 5, 6, some even 7. So basically, that's the, again, advantage you have, that when they move, they really move. So we had a nice day in gold, but not that nice. But then your miners, really, you can see how many greens they were. So that's my screen, and that's one of the reasons it's a good idea to be a little selective and play the gold miner, or I mean, precious metal or the actual miners. I want to also look at just a chart of, this is before the close today. So you can see how the GDX has been behaving. And I look at the 3, 8, and 21 day exponential moving average. So you see we've had, from the beginning of February, we've had a nice bounce. So if you want to play options, they're pretty liquid. So this is from looking at from the chart point of view. So I look at the MACD, look at the RSI, and you can look at the, again, stochastics. You see we were oversold, we were close to oversold, and then MACD just crossed. So basically that's one of the ways to analyze it. On top of that, we look at the still big picture. We want to look at the relationship between gold and the dollar. So this is one of my favorites. Last week, we talked about the pairing, relative strength. And in this situation, you can see I've gone on a weekly basis, gone back to 2019. how gold has behaved relative to dollar. And you see, in March of right after COVID, the dollar becomes strong at that moment, flight to quality, and then gold really sold off, and it was the ratio was at 14 gold to dollar. And then, we moved all the way to like 22. So right now, if you look at the average, and this is a 50-day moving average, 14 and 22, basically in this situation, about 18 will be the mean. So, and we are really floating right, the relationship has been right in the mean. So again, gold should have really, with the inflation and everything, should be going to the roof, but the dollar also has been strong because of not just not this week, but because of, again, the flight to safety because of geopolitical, but also the higher interest rates coming. So this is what I want to watch maybe on a weekly basis. On top of that, what we want to watch is what is the relationship gold and the miners. So this is how you can see, wait a minute, in March, remember, all the equities dropped. So what happened? The gold, obviously the price of gold relative to equities was much better, more attractive, and the equities completely dropped. And after that, basically, then the gold had a big drop, and the miners basically they started moving, but then in the last since April of August of 2020, we've had a overperformance by gold than GDX. So we went from the relative ratio of 47.5, we hit the 60. So do want to watch this, because if it gets to a point that it is really overextended, then that's a good time to actually get into the miners. So the reason I want to share this with you is not just from the valuation point of view. What I want to say is the miners don't just copy what gold is doing. You can see, gold could be in its own world, and miners can really either become really cheap or they can be very expensive. So that's what you have to follow. And this is from the daily. I looked at it the other way. What is GDX is doing compared to gold? And we are right in the middle of the road right now. So we were cheap. We went to that support zone and has done well. So this is more of a, when we are more expensive compared to gold. So these are just a ratio analysis. The other thing you can do is basically look at the correlation of the miners compared to gold. So granted, again, the commodity is your guidance. So you want to watch what the commodity is doing, but they don't correlate one-to-one all the time. So for instance, in August of 2021, August 16, you could see we actually went to a negative relation between the miners and gold. And then we went to that one. As a matter of fact, right in the, in middle of December, which historically is good for gold, the correlation was actually about 0.2, 0.3. So you want to watch this also. So they don't correspond all the time 100% to their own commodities. Right now, they're following. So this tells you that whatever gold does, that then the miners will do. But you want to see sometimes the discrepancies. So the correlation is important. So with that in mind, let me just share a couple ideas as how do I look at individual stocks. So one would be in gold arena, the other one would be on other industrial mining. So one would be American, one would be international. So this is from Finviz. You can see we've had a nice uptrend since December in new mining. You see that they have a pretty attractive debt to equity. The PE is, forward PE is okay. And the gross margins are good. They're up so far 2.48%. All the stocks are down. So that's one way, just to overall look at the picture. This is from the Investor Business Daily ranking. And overall, their composite ranking 78. Anything over 80 is a good good candidate. So they are the largest, but they are ranked 7th from the composite point of view. And as you can see, they are in the producer of gold in US, Australia, Canada, Ghana, Peru, Suriname, Mexico, Argentina, and Dominican Republic. So the number one from the composite point of view is the Franklin, Nevada, and then we have the gold fields. So basically, just to show you as far as, from the relative strength that we talked past, Newmont Mining is 5th from point of view of earning per share ratings. Real Gold is number 1 and they're 5th. And then from the accumulation distribution, which is basically tells you how the institutions are investing in this company. So the more inflow by the institutions rather than redemption or distribution, the higher the rating. So you have the A, B, C, D, and they are ranked 10th. And the SMR, which is the sales and margins we will look at in the next slide, they are ranked very low. They're 26. So this is more of a fundamental balance sheets information. So from the point of view of industry rank, it is not very strong. So their relative strength, they're ranked actually C minus. Earning per share, it's ranked, well, it was 79, but compare, as I said, 80 is, usually we like to have 80 or plus. And then we look at they have a 45% 3-year earning per share growth. And for the current year, they only projected 11%. As far as sales and the margins and return on equity, they are rated B. So that's positive, but they are ranked lower than other ones. So we want to take that into consideration. And their debt to equity ratio, as I mentioned, is pretty good. What they're lacking is the return on equity and their sales growth compared to others. This is just more of internal, and you can see the market capitalization, accumulation, distribution. So basically, this is from Investor Business Daily. So let's travel and go to Thinkorswim, and let's look at to see how the Newmont Mining, can we look under the hood and see if there's any attractive information that help us. So if you notice, they were all over the globe. So we want to look at where the revenues are coming. So basically, if you go to your trading portion of your Thinkorswim, you can take a look at the company profile. So you click on that, and this tells you a couple of things. Number one, they have their own underlying analysis, and from valuation point of view, according to this, is Newmont Mining undervalued by 5%. So instead of $63, they should be valued at $66. But what I'm interested is I want to see where majority of activity comes from. So you can see the North American gold mines, they account for 43.6%. Asia Pacific is 20.5%. African is about 13.4%. South America is 12.1%, and other is very small. Other one's 9.7%. This is what I want to review with you. And again, you click on this. So we want to see how is their number one revenues and their shipments. We talked about shipments, right? And also I want to see how much they're realizing per ounce of gold. So we want to look at their margins. So this is in North America. I look at this and I notice, wow, so far in last 12 months, for instance, they have gone from 2 million to 4 million. So they've been actually shipping more. So that's a good activity. That's 100% growth. Also, the average realized price per ounce has gone from 1,000 It's been moving up and it's about 2000. So that also is very helpful. So now you have revenues up in a sense of the shipping, activities up, and the margins are up. So basically that's positive, and that's why the margins have gone to 54.8%. So that's good news. So we want to, whenever you look at the miners, you want to check where the really the revenues are coming, where are they lagging, where are they leading, and then you can continue with that. And I just want to take a look at, for instance, what is happening with the in Asia Pacific, which is 20 and a half, and with the Asia Pacific, for instance, just move, they were at they're a bit, well, I'll start from the bottom. So their per ounce has been moving up, but their activities actually, from the shipping side, they actually are lagging and they have gone down. So basically that's we want to take into consideration. And because of that, what we could see is actually, well, because of the growth in the shipping, the margins are still okay. So we want to, again, take everything into consideration. And then the next line, it tells you, which is really good. I mean, again, if you have time to look at where they're operating, who's buying from them, who are the competitors, the companies from Barrick Gold, Anglo Gold, and basically this is important to see, again, the competition. Then you can go to the fundamental side, which gives you a lot of information. Again, because of interest of time, I don't want to go too far into it. I just want to show you some of the analysts, for instance, where they rank, and as far as how many they've ranked them as a reduce, who is the research team or the CFRA puts them at hold. In a market edge, for instance, they are buy, and the street says buy, and then market edge is a long. So, and then these are you can look at the profit margins, for instance, where we want to see year over year, as far as the revenues, where they're coming from, as far as their profitability. So that's what basically your Thinkorswim allows you to do. So, and then this is their chart. You can see they've been nicely above their 21-day moving average. They had a couple of days down and they moved back up. So the correlation with gold, again, you can see now they're pretty close. So they move with gold, so that helps you. But we want to watch this. We also want to watch the correlation to gold and dollar, for instance. So take advantage of this, again, this analytical tool. My second choice is that I want to go for other industrial material, and that's BHP, which is based in Australia. The reason I chose this is an international company, and you will see during an analysis, when you're at companies, especially in Asia and like in South America, because they're not required to file with EDGAR, sometimes the information are not as available as, let's say, US-based and even Canadian-based companies. So BHP is the largest company, especially in iron ore and metals. And you see it's a $177 billion company. It has 34,000, over 30 employees, very liquid. The average volume is 4.6 million. So if you want to analyze that, we can see they're ranked very highly. Their composite rank is 98, which is very good. They're ranked second. They're ranked from the relative strength, they are at the 10th. So you can see Alcoa is the number one. And basically, from the fundamental side, you can see like the Freeport-McMoRan is second. They are fifth. And also from accumulation distribution, you can see the group ranking, though, you can see completely different than from gold and even silver. But gold's more so, especially silver still has some industrial use. You can see their industry is ranked 42. Again, the demand of the global demand is the economy opening up. So they are ranked, the SMR ranking is A, they have good profit margins, they have a good return on equity, and the accumulation distribution is B minus. Their up-down volume is 1.4. We want to look anything over 1. And I just want to show you, it's just a little explanation. The 50 ratio, that the ratio that is derived by dividing the total volume on up days compared to the total volume on the down days. So obviously, if it's more than 1, there's more up days volume. This I want to share with you. So when you go, let's say on Thinkorswim, now you want to go to, we looked at the NEM as far as a company profile. Well, there's not one for BHP. And when you go to fundamental analysis, it's very brief. So again, there's not as much information on Thinkorswim for BHP, again, because it's based in Australia. So take that into consideration when you're investing internationally. You need to dig a little more on your own. As far as the chart, you can see we've been above that 21-day exponential moving average. So I want to move and say, well, how about Rio Tinto, which was the second largest, and they're based in UK. So now with that, you can see, well, I have more information available. Like for instance, for the Rio, I can see that first of all, they're a little overvalued compared to what they are now. Iron ore is about 76.9% of their business. And there's some copper, aluminum. And then, so again, the average, when you look at the realized price has gone up nicely. And what we can see, the shipping activity has been going higher. Now, what happened now that EBITDA, so we got to take into account what has happened as far as the amortization, the taxes, the interest. So we got to dig deeper. Now the competitors are, Bale, BHP, and or Skeo Metals Group. So last, what I wanted to share with you is just interesting. I wanted to look at the Newmont mining compared to UMP Railroad. So, and you can see, it's interesting to see if there's any divergence, but we want to see if there's strong movement in railroads. Usually pulls the in different way. I mean, that's why we have a little discrepancy depending on the cost of shipping, but also activities tells us how much revenues will come. Okay, with that in mind, I hope it was informative. At least again, we touched the surface, but I want to share this with you to make sure that you feel a little more comfortable if you wanted to invest in the mining stocks. With that in mind, we can stop the recording and open up for any type of questions. Thank you.